Good morning, everybody. Welcome to our Thursday Q&A session. I'm with my colleague Fisa Kushle Mbutu, and I think we've got Sean on the line as well. We're going to be talking about Woolies today, so look forward to that take. I will open for questions and answers straight after the technical bit. Please get your questions ready and or type them in the chat. We look forward to hearing from you and your participation. Okay, Fisa Kushle, I'm going to hand straight over to you. Thanks, mate.
Perfect. Thank you, Sarl. Good morning, everyone. Like Sarl said, I'm Fisogo Mbuto, and today I'll be taking you through some of the highlights from our Woolworths company update report. So just starting on the summary side of things, we have a buy on stock, primarily because of the strong food performance, to offset the volume pressure we're seeing in fashion, beauty, and home, and then the macro in Country Road Group. So what we've been seeing is that the food business is performing quite well. The fashion, beauty, and home business is being turned around. They're increasing prices, but they're having issues with volumes. And then with Country Road Group, what we're seeing is that there was a recovery between 2019 and 2023, but when things started to normalize, the reality of the pressured macro of the consumer started to settle them quite a bit. And that's why we've been seeing a detraction in performance out of Country Road Group in the last 2 years. But there's still some upside potential coming out of the last two segments. Now, we have an intrinsic value of 67 Rand per share with an upside of 33%. As of today, probably would be closer to about 31%. The 33% is for when we last released our report. Now, recommendation is based on the low valuations on Woolworths on a risk-adjusted basis, considering all three segments in the current consumer environment. So what we're going to do is we're going to split the two our regions of operations, South Africa and Australia, and sort of break down where the macro is, how it could impact the consumer, and how it would impact all three segments. Now, we expect the food business to continue to be a stellar performer. It has been a really good performer over the last few years, and holding its margins and expanding on volumes while increasing prices. So, if you remember, the food business has gradually become a greater piece of Woolworths pie. Now, the food business performs a lot like a staple, so it means they give us a little bit more stability, and then the bigger risks actually come from the fashion, beauty, and Country Road Group side, because those are traditionally more consumer discretionary. Now, we expect Country Road Group to provide some upside potential from a recovery in consumer spending with easing inflation and decreasing interest rates. But what we'll look at in a few charts ahead is that when we look at where the interest rate is for Australia, it's been coming down, but not as fast as it went up. When we look at core inflation and headline inflation, it's at the higher end of the Reserve Bank of Australia's target range. And then we'll also contextualize it a little bit with where food and housing inflation is and how it can pivot and filter into the performance of Country Road Group. Now, we expect fashion, beauty, and homes turnaround to continue, with full price sales being a large portion of its revenue. Now, when we look at FY25 results, specifically with fashion, beauty, and home, you would have seen that full price sales now are around 80% of that segment's revenue, which has been primarily its goal to be a lot more focused on full price sales, less discounts, increasing prices. But the counter to that is that you start feeling a lot of pressure coming out of your volumes. But now the last point is more so considering the upside that we're seeing in Woolworths, that 33%/31% as of today. We highlight some risks presented in the consumer environment in both the regions, particularly in interest rates, inflation, and how that filters into performance of all the three segments. Consumers in both regions continue to face macro pressure, as evident in Country Road Group's performance, especially in the last 2 years. And then fashion, beauty, and home is a volume pressure, which I'll showcase what the histories look like in the last 7 years. But considering that, we still anticipate that the risks of those two segments should be offset by the strength of the food business, which works a lot more like a staple, providing us a little bit more stability out of the business and some upside potential coming out of the more riskier side, which is the fashion, beauty, and home, and Country Road Group. Now, from a valuation perspective, just to add a little bit of context. So we had this slide for Mr. Price the last time we did a presentation, but we've sort of adjusted it a little bit. What we've done is, because Woolworths is part food and part clothing, we've added Mr. Price as a comparison and also added ShopRite, one of the quality food businesses, as a comparison as well, to contextualize the numbers a little bit better. Now, we see that Woolworths' strong food business keeps those valuations quite high. There's a potential recovery in Country Road Group, and then there's that business of fashion, beauty, and home, which is being turned around. It positions the current Woolworths as attractively priced. And the question might be how so? Now, when we contextualize that next 12 months PE, looking at what the valuations are, that 13 times PE is primarily just that food business. Food business is about 64% of revenue. It's that food business's strength. Now we expect that those numbers should see a little bit of an uptick coming from the performance of, or at least a recovery from Country Road Group, and then a turnaround at that fashion, beauty, and home business. But really, primarily the strength there is that food business, and that's really what you're paying up for. Then I'm not going to spend too much time on Mr. Price. Sort of spoken a lot more there. And when we look at Woolworths and Mr. Price, they're offering slightly different value propositions. Mr. Price, from a clothing perspective, is a lot more value, low priced pricing points, whereas Woolworths Fashion, Beauty, and Home is more on the higher end of pricing. So it's not necessarily a like-for-like comparison, but it is comparing a quality clothing business to a quality overall business. And then we've got ShopRite there. I'm not going to spend too much time on that as well, but we all know that the ShopRite business is high quality. We check at 60, all of the likes, but the primary focus today is just going to be on Woolworths. And this kind of contextualizes that the current level of the PE primarily focuses on the strength of the food business, and there is some upside potential from the recovery of Country Road Group and the turnaround of Fashion, Beauty, and Home. Now I want to contextualize the two regions of operation, South Africa and Australia, with the segments that operate in those regions. So we're going to start with the historic food and fashion, beauty, and home top line growth history over the last 7 years. So both segments have had price increases, with fashion, beauty, and home's volumes, though, feeling larger pressure. And the reason there is fashion, beauty, and home is a lot more discretionary. The food business is closer to staple than than consumer discretionary, and you can actually sort of see it. So we've sort of split these into two, and then highlighted like-for-like volume, like-for-like growth and volumes in a sort of a reddish pinkish color, then price inflation in a greenish color. Sort of highlights it a little bit more. Now, when you're looking at the price inflation for food, you can sort of see that from 2019 to 2025, they have been increasing food prices. But the interesting part is actually in those pinkish reddish colors, because volumes have remained quite stable. And like-for-like growth has remained quite positive. I mean, the worst for food business was in 2023 when those volumes were down 2%, but they had increased prices at about 8.3%, which is, in terms of range, is a little bit out of the ordinary. So you would expect that kind of volume decrease, but that was the worst over the last 7 years. But when you contextualize it about fashion, beauty, and home, similarly, when you look at the price inflation, so that's the table at the bottom. Price inflation between 2019 2025 has been increasing. But when you look at volumes, that's where the pressure is. Fashion, beauty, and home has only had 1 year of positive volume in the last 7, which was just 2022. And it was only up 1.3%. So you can sort of see that the business has been trying to gradually turn around, and it is somewhat doing okay, because in 2025, those volumes have been flat, and they increased their pricing by 5.3%. 80% of their revenue is now full price sales, but you can sort of see that it is a lot more discretionary in a price sensitive consumer environment. The food business, yes, you can increase prices. There has been some pressure on volumes, but like-for-like growth remains strong, and the food business performs like a staple. And now we want to contextualize how all of that and the macro environment filters into those two segments. Now, I've showed a similar chart with Mr. Price. I like the chart. It gives a little bit of a better picture, and I've included it for Woolworths as well. So what we're still seeing, again, rates are being cut, core and headline inflation is coming down, but food and housing remains high in terms of inflation. And that food and housing is one of those day-to-day impacts that the consumer will feel, which will definitely impact the way that they spend their money, specifically on the consumer discretionary side. When it comes to food, acts more like a staple. You can sort of see a little bit of strength coming in there, but when it comes to consumer discretionary, those two highlights can really determine whether you're deciding to buy at a Woolworths, at a TFG, or a Mr. Price. Right, now how does this all fit into the picture? When you're looking at that red and green line, so that's the headline and core inflation. That's at the bottom end of the SARB's 3 to 6% inflation target range. And when you look at that blue line, that's the interest rates, right? In the last SARB meeting, they kept those flat. But what we're still seeing is that they have been gradually decreasing over the last year or so, but they're still decreasing at a slower rate than they increased. And then those two food and housing inflation numbers start to really make an impact on the consumer decision making, right? Housing inflation, high. at about 10.43%. Food inflation in the higher end of that 3 to 6% range at about 5.22%. So you can sort of see that when it comes to discretionary spending, the consumer is highly pressured, which is why we're starting to see a little pressure coming out of the consumer discretionary side. And it's not really a Woolworths only issue. It's a sector issue. It's really a sector-wide issue. And what this highlights is that the strength of the food business is really going to keep Woolworths afloat, which in one end is a bit of a risk, but on the other end, it gives you the upside potential to come out of the food, fashion, beauty, and home business to really concrete and make those that upside concrete for Woolworths through fashion, beauty, and home, which is only one side of the argument. Now, the other side of the argument is really Country Road Group, specifically just Australia. So what I have here is something similar to what we showed with food and fashion, beauty, and home, but because they report slightly differently, I've only included revenue growth and some context on what the numbers have looked like and the reasons why they've looked like that. So I've seen volatile jumps in the last 7 years. They were primarily due to, number one, low bases, and then very specific circumstances. But the headwinds to the consumer have remained the same, which is why in 2024 and 2025, we've seen a decrease in revenue for Country Road Group. Now let's take it back to between 2019 and 2021 to really contextualize where the performance is and where the upside potential is, while also highlighting those risks, right? So 2019 to 2021, there was COVID, right? 2019 to 2020 was COVID. Then we saw a low base and a reopening. But the performance of Country Road Group in 2021 was primarily because there was a low base in 2020. And number two, there was some small reopens with the primary performance actually coming from digital more than anything else, right? And then we transfer into 2022. In 2022, the performance was flat, which is actually good when you contextualize the fact that they had been down about 13.7% in 2020, and then they had a little bit of recovery in 2021. Flat performance in 2022. Not exactly bad. But what had happened between 22 and 23 is an increase of about 21%. This is all in rands, by the way. And that increase has been primarily because of discounting to clear out inventory and then a return to physical stores. So you're almost getting a double uptick of, in 2021, it was sort of a small reopen. People are ordering clothes online now. Then in 2023, back to physical stores. So it's still a big uptick. Now, what kind of context does this provide for us? It means that between 2019 and 2023, there was almost a complete recovery in terms of revenue for Country Road Group. So now the reality of the pressure on the consumers actually started to show up in 2024 and 2025 because of high inflation. Interest rates are still elevated. Now it is impacting the pocket of the consumer, and we are seeing a detraction in performance in Country Road Group. So in 2024-25, we saw a struggling consumer because of the Australian macro backdrop. Sort of leads us into this similar chart to the one that we saw for South Africa. Right? We look at exactly the same things: headline inflation, core inflation, housing, food inflation, and then also look at interest rates. And it's almost a similar story. The only difference is that inflation here is at the higher end of the Reserve Bank of Australia's target range of 2 to 3%. So what are we looking at? Again, the green and red lines. Core and headline inflation, 3.26%, 2.98%, at the higher end of that 2 to 3% range. Then we look at where the interest rates are, right? At about 3.6. They're coming down. However, they are not coming down at the same pace that they went up. Now, we can argue that there were different economical circumstances, but the point is that the consumer is still feeling pressure. And then when we add extra context of housing and food inflation, which both those inflations affect the day-to-day consumer decision-making on what and when to buy, are still on the higher end of that 2 to 3% target inflation rate. What does that mean for Country Road Group? It means that between 2019 to 2023, the company did see a recovery from a revenue perspective. But post that, so 2024, 2025, the reality of where the consumer is starts to settle in after things have normalized, which is why we saw a detraction in 2024 and 2025, because inflation still remains high, interest rates still remain high, and particularly food and housing inflation still remains high. So that means as a consumer, you sort of decide, do I really want to buy clothes today or next year, based on where the pockets or / disposable income is right now? And the answer to that question will typically be later instead of now, which is why we've been seeing a detraction in performance in Country Road Group, as you would see in the last 2 years, 2024 and 2025. So this paints us a really interesting picture of where the consumer is in Australia and how that filters into Woolworths overall. But we have to always keep in mind that food business is still doing quite well. It's still strong, and it's 64% of revenue. So even though there is risk in Country Road Group / Australia, it is a little bit offset by the performance and strength of that food business. Then margins, right? Margins contextualize really what's going on in the business and what really to think about going forward, right? So the margin for Woolworths, they've seen pressure over time, but they've been primarily kept afloat by that food business. Right, we will start with gross profit, right? Again, so we've added ShopRite, we've added Mr. Price here to sort of look at both sides of Woolworths. ShopRite for food, and then Mr. Price for fashion, beauty, and home / Country Road Group. Right, when looking at Woolworths, so that would be the blue line. If we're looking at their gross margin over the last 10 years, it's actually come down quite a bit. And then over the last 5 years, it's been gradually coming down as well. But the risks there and where that has actually been coming from has been discount sales and the consumer discretionary side of the business. So Country Road Group and fashion, beauty, and home. The food business has been relatively doing okay, which means those margins have been coming down. But the primary driver of those has actually not been the food business. It's been the discretionary side of the business. So it kind of gives Woolworths a little bit of strength, especially because the food business is about 60% of revenue. Now let's go a little bit further down in the income statement to the operating margin. Sort of a similar story, right? If we look at Woolworths over the last 10 years, it sort of remained about flat, but over the last 5 years, it's where you've sort of seeing pressure from a consumer discretionary side. Again, the margins have been coming down, primarily led by discount sales in Country Road Group and in fashion, beauty, and home. Although the fashion, beauty, and home business is turning around, they're doing less discount sales, sort of seeing that it's been a gradual change. Even now, it's still about 80% of the revenue is full price sales. So there's still like 20% is still putting a little bit of pressure on margins, which is what we're seeing on the operating margin line. And then finally, at the bottom end, we have your net margin, really where it really counts, right? What we're seeing there is strong, stable margins coming out of ShopRite, the red line. Unsurprised, staple, it does well, it does consistently well, it's a quality company. But when we're looking at that blue line, which is Woolworths, you can sort of see again that it's been coming down over the last 5 years, and again, primarily coming from write-downs in Australia, discount sales in Australia, as well as some discount sales coming out of fashion, beauty, and home. Sort of highlights that food business is actually the golden age for Woolworths and the reason why it's staying afloat, which positions the company actually in a very interesting position, because what you're paying up for right now is the food business, but the upside potential is actually coming from the fashion, beauty, and home and Country Road Group, assuming that number one, Country Road Group recovers, the consumer recovers, and then number two, fashion, beauty, and home, number one, the consumer recovers, and then number two, they continue with their turnaround. Right, and then it all filters down to EPS. So EPS and margin will almost tell you a similar story. You can sort of see that the EPS there has remained almost flat over the last, call it 5 odd years, but the upside potential there again is not coming really primarily out of the food business. It's coming out of Australia and fashion, beauty, and home. Then we'll start to see some earnings picking up, bringing that share price up as well. Then from a valuation perspective, so there's a few things that have been sort of hammering on with the 3 segments, right? Number one, the risk around the consumer and Country Road Group in Australia, right? Australia not doing well in the last 2 years. Consumer is under pressure. What does this mean for Country Road Group? Because it's a smaller piece of the pie, the risk remains, but it is offset by that food business, which means that, yes, we expect a little bit of pressure to continue from Country Road Group, but when the consumer recovers, there should be a lot of runway for Country Road Group to recover and then start positively contributing to earnings and operating income. Then we've got that fashion, beauty, and home business. There, the risk is not necessarily just an increase in prices, but it's actually more in volumes. They can increase the prices, but because of the current macro environment the South African consumer is in, they're going to see some volume pressure. We saw it in the table that I displayed. And over time, as the consumer recovers, as inflation alleviates and interest rates come down, we should see a little bit of an uptick in fashion, beauty, and home, where they'll start selling more full price sales, increasing prices a little bit more and having a lot less volume pressure. Then we have the food business. right? Doing quite well, margins strong, increasing prices, volumes not feeling too much pressure. I think the bigger risks for food here is that they can only increase prices for so long before something actually breaks. Now, the Woolworths food consumer is quite resilient, quite strong, as we've seen in like-for-like growth growing quite consistently. But there have been some instances where Woolworths has increased their pricing a little bit more than usual, and it has had a negative impact on volume. So that still remains a risk. But overall, it is a smaller relative risk when compared to what's happening in Country Road Group / Australia and what's happening in fashion, beauty, and home. So now, taking that into context, what have we done? We have skewed the scenario weights to the bear case because we recognize that there's a lot of risk in the operating side of the business. But even considering that on a risk-adjusted basis, which was one of our first points in where our recommendation is going, there's still a low valuation, still attractively priced. We still see an upside of about 31% as of today, which really highlights why the stock is a buy, but you need to be very conscious of the kind of risks that you would be taking on the stock. Then lastly, just at the bottom, what we see there is just a 12 months total return chart, which has Shoprite in the red, Mr. Price in the black, and Woolworths in the blue. And what we're trying to highlight there is, we expect Shoprite to do a little bit better. It's a quality company. We all know and love Shoprite. Then you've got Mr. Price, which has a slightly different value proposition to Woolworths Fashion, Beauty and Home, but has been doing relatively okay when compared to a Woolworths. And then we have Woolworths, the cyan line, right? Which brings us back to that valuation. What exactly are you buying now? Where is the upside potential? You're currently now buying that food business at a lower end relative to if you just bought a full staple, full quality business like a ShopRite, and considering some upside potential from a discretionary side with fashion, beauty, and home and Country Road Group, which again sort of highlights that yes, there are risks, but yes, there is still some upside potential coming out of the business, and you got some downside protection because of the staple performance of the food business. So that brings me to the end of my presentation. So I'm now going to hand over to Sean to take us through the technical view for Woolworths.
Yeah, good morning, everybody. Fiza, thanks for a very comprehensive analysis of Woolies. I also like this share a lot. You can see there by the chart that it has been trading below its 200-day moving averages for a while, but also below its 20 and 50-day moving averages. So yes, it has been bearish. But saying that, you can also see there's been trading within I call it a little slight up channel. So it recently has bounced off that lower support of that up channel. And I see it today still holding it. So I will also confirm with you that it's got a lot of upside potential. The MACD indicator at the bottom there is trading in oversold territory and just below its, we call it the trigger line with no clear bullish signals yet. But saying that other shorter-term technical indicators like the RSI and stochastic are giving bullish signals. So I'll confirm with you that, it looks good at this point in time, and I agree with you that upside potential, 33% or 31% up to 67 Rand looks good. Thank you.
Yeah, thanks, Sean. Thanks, Fiso. If I look at the chart like this, then those levels that you highlighted, I looked at the chart, got the same levels. I think it's a good trade. If you put your stop loss around 47, which is that previous double bottom support. So buying around 51 where it's trading today, stop at 47, possible first stop target around 58. So that's what, 7 rands upside versus 5 rands downside. It's just more than 1 times the risk reward ratio. And then obviously the next pivot point is there close to $60 at around, what's it there? So what is it? 60, 58. That's right. That's what we spoke about. And then up to about 68. So the levels are pretty much 48, 58, 68 if you want to do a trade on Woolies, in my opinion. Yeah, no spike in volume, nothing funny. So I think this little up channel of yours may hold. All right, I see we've used up a lot of time, and Fisa, thank you. You've been very comprehensive. Let's see if there are any questions, and we'll hop straight to them. Yeah, I don't see any questions. I think you were too comprehensive, Fisa, man. You left the oaks with nothing. All right.
I mean, sorry to interject this, Sarl. I think
Yes.
one thing that I'm thinking now, and it's quite an interesting one for Woolworths going forward, is that if you look over the last 7 years, the food business has been about just a little bit half. And then over the last 3 or 4, when they dispose of David Jones, now it's closer to about 60%. And as it performs well and Fashion Beauty and Home and Country Girl Group doesn't, we could expect that number to go up. So eventually, the question actually becomes less about are you buying Woolworths for Fashion Beauty and Home? It's more, are you buying the food business? And as that number goes up and the discretionary side of the business goes down, you kind of have to ask yourself the question of, at the current prices, is it fairly valued or not? And that's really where the debate starts to happen. Because if you look at that slide I showed with the next 12 month PE, and actually, let me go to that slide now. There we go. The next 12 month PE for Woolworths, Mr. Price, and ShopRite, you can actually sort of see that in terms of if you're only comparing Woolworths to a consumer discretionary, no food involved, you can sort of see that it's doing exactly what it should be doing. The consumer's under pressure, so you would expect that the valuation multiples as well should feel some pressure. But when you compare it to something like a ShopRite, which is a quality food business, which has good amount of runway, good amount of upside, you can start to see that Woolworths is one of the quality companies where you get the best of both worlds. But over time, you're going to have to start asking yourself the question of, do I care about Country Road Group and Fashion Beauty and Home because of the strength of that food business? I mean, that food business increases prices all the time, and volumes aren't affected as much as a more discretionary one like Fashion Beauty and Home. So, I mean, I like the stock. I think there's a lot of risks in it. But that food business starts giving us a very interesting question over time of what exactly are we buying with Woolworths? What really is the picture when you talk about
I think the food business is a big part.
Yes.
I think I saw a number that just more than 40% of their total sales is now through Dash. So people are getting their groceries wheeled to them. I'd rather buy tomatoes from Woolies than from Checkers 6060 because you know what you're going to get. So I think they got that in their favor. They are flipping expensive. I mean, every time my wife comes back with 2 Woolies bags, I go check my banking app to see whether I've got anything left.
So that's the other side of that argument, Sarl.
But that said, the quality's there.
Prices?
Yeah, quality's there. Once the consumer, and I don't think the consumer that buys at Woolies is really that much under pressure.
Yes.
Yeah. So that also. Yeah, I don't see any other questions, guys. Fisa, I agree fully with your analysis. I think it's fairly valued. I think it's technically at a level where there's clearly defined levels. You know, you can define a stop loss easily. You can define a target easily. So worth a look at if you're a trader. If you're a long-term investor, I guess you could wait for slightly cheaper days. I mean, the consumer is not going to get out of the hole in the next couple of months. But so we may see it hang around here for a while. But if you're a trader, I would certainly give it a consideration. We'll be back next week. I think, Sean, do you know what's on the calendar?
I think it's Discovery.
Okay, yeah, I also think it's Discovery. So we'll see you guys next week, Thursday, with Discovery. We look forward to hosting you, and thanks for joining us today. Have a great Thursday. Cheers.
Cheers.